Hi, everyone, and welcome back to Capital Chronicles. Today, we're diving into a fascinating topic that spans more than a century of financial history: trend following investing. We'll be exploring the key findings from the influential paper, A Century of Evidence on Trend Following Investing, by Brian Hurst, Yao Huaui, and Lasse Peterson, published in fall 2017. Whether you're new to the concept or looking to deepen your understanding, this video will break down why trend-following strategies have worked and may continue to work forever. Let's start with the basics. At its core, trend following is all about capturing persistent movements in asset prices. The idea is simple: buy assets that are trending upward and sell or short those that are trending downward. This isn't a new idea. Historical figures like David Ricardo long ago suggested, cut your losses and let your profits run, while legendary trader Jesse Livermore famously advised that big money isn't made on small moves. These timeless insights set the stage for what we now call time series momentum, which is the foundation of many modern trend-following strategies. The study we're discussing takes a deep dive into one of the simplest yet most robust versions of trend following, the time series momentum strategy. Here's how it works. The strategy examines the past performance of an asset, typically over periods like 1, 3, or 12 months. If an asset's recent return is positive, the strategy goes long. If negative, it goes short. Each position is adjusted or scaled to target a consistent level of risk, ensuring that no single market overwhelms the portfolio. This systematic approach has been applied across a wide range of markets, including equities, bonds, currencies, and commodities. The paper even takes us all the way back to 1880, providing a rare long-term perspective on the efficacy of trend following. Link to the paper in the description below. One of the most impressive aspects of this study is the dataset itself. The authors compiled monthly return data from 67 different markets, spanning 4 major asset classes. For some asset classes, like commodities, they even went back to manually transcribe data from as early as 1877. By combining futures returns with cash index returns for periods before modern futures data was available, they constructed a realistic simulation of a trend-following strategy over more than 130 years. To mimic real-world trading, the researchers simulated rolling futures contracts. This means they periodically switched from the expiring contract to the next one, much like an actual fund manager would do. They also adjusted for risk by targeting a constant level of annualized volatility, around 10%. And importantly, they took into account transaction costs and common fee structures to see how the strategy might perform in practice. Now, what do the results show? Remarkably, the strategy has been consistently profitable over the entire sample period, even through some of the most turbulent times in financial history. Here are a few key takeaways. Resilience across decades. From the Great Depression to the global financial crisis, time series momentum has delivered positive returns in nearly every decade. The evidence suggests that the existence of price trends is not merely a statistical fluke or a product of data mining. It's a persistent market phenomenon. Robust across asset classes. Whether it's equities, bonds, currencies, or commodities, the trend-following approach has worked broadly. In fact, when you look at individual markets, the average Sharpe ratio, a measure of risk-adjusted return, comes in at around 0.4, indicating a respectable level of performance across the board. Diversification benefits. One of the most exciting aspects is how trend following can complement traditional portfolios. When a 20% allocation to a trend-following strategy is added to a classic 60-40 stock bond portfolio, it not only boosts returns but also reduces drawdowns and overall portfolio volatility. This diversification effect is particularly valuable during market crises. The paper also sheds light on how trend following performs during extreme market events. Interestingly, the strategy tends to do very well in major bear markets. Because many downward markets develop gradually over several months, trend followers have time to build short positions and profit from the decline. Even during deep drawdowns, such as those experienced by a traditional 60-40 portfolio, trend-following strategies have often produced positive returns. This defensive and uncorrelated characteristic can help investors weather stormy periods. So, why has this strategy endured for over a century? The answer lies in a combination of market structure and human behavior. Behavioral biases. Investors are prone to emotional decision making. Whether it's fear, greed, or herding behavior, these psychological factors cause prices to trend in one direction for extended periods. In essence, market participants often fail to immediately correct mispricings, creating opportunities for trend followers. Market microstructure. Certain market mechanisms, like central bank interventions or corporate hedging activities, can slow the process of information being fully reflected in prices. This delay often results in trends that trend followers can capture. Diversification and risk management. By adjusting positions to maintain a constant level of volatility, trend-following strategies protect against large losses, ensuring that even during choppy or sideways markets, the overall portfolio risk is managed effectively. While the evidence is compelling, it's important to note a few caveats. No strategy is without its downsides. For instance, transaction costs and fees. The study carefully simulates these costs, which can erode returns. In real-world settings, higher costs might impact performance. Rapid market movements. The strategy relies on trends that develop over time. In very sudden market crashes, like the 1987 stock market crash, there might not be enough time for trend signals to be generated. Changing market dynamics. Although the study covers more than a century, markets continuously evolve. It's crucial for any trend-following strategy to adapt as new market conditions and technologies emerge. For long-term investors, the key takeaway is that trend-following strategies can serve as a robust complement to more traditional investment approaches. By capturing a unique source of return that is largely uncorrelated with stocks and bonds, these strategies provide a form of insurance during periods of market stress. Even with the occasional drawdown, the overall historical performance suggests that trend following is here to stay, rooted in both enduring behavioral biases and the inherent structure of global markets. In summary, a century of evidence on trend-following investing makes a powerful case. Trends are not anomalies, but rather a persistent feature of financial markets. Whether you're considering trend following as a core investment strategy or as a diversification tool within a broader portfolio, the long-term data supports its inclusion. Thank you so much for watching. If you found this video helpful, please hit the like button, subscribe to our channel for more insights on investment strategies, and leave a comment down below if you have any questions or thoughts on trend following. And don't forget to check out the links in the description for further reading on this topic. Until next time.